Right now, as we speak, Plug Power stock, ticker symbol PLUG, is changing hands at exactly $1.93 per share, showing a sharp intraday upward push of over 12% in this trading session. If you are watching the charts this morning, you are seeing a battleground. The stock opened near $1.88, dipped to a low of $1.89, and has since surged to test the $1.95 level, driven by high volume that suggests a massive fight between aggressive short sellers and speculative retail buyers. This isn't just a standard day of trading. It is a volatility event that mirrors the kind of erratic movement we often see in Tesla stock during its most contentious earnings weeks. The market is reacting in real time to a complex mix of financing news and a strategic pivot that most investors haven't fully digested yet. The expectation right now is that Plug Power is simply a distressed asset, a company burning through cash with no end in sight, destined to fade away as the hydrogen hype cycle dies down. That is the narrative you will see on the message boards and the headlines, but the actual situation developing on the balance sheet and in the boardroom is far more nuanced and potentially explosive. The reality is that Plug Power is no longer just a pure-play hydrogen bet. It is actively restructuring its entire financial survival strategy around the booming demand for data center power, essentially trying to backdoor its way into the AI infrastructure trade. This distinction between the distressed hydrogen expectation and the energy infrastructure reality is where your opportunity lies, and that is what we are going to break down today. When you look at the immediate price action, that 12% jump to $1.93 might seem like a relief rally, but you need to understand the mechanics underneath it. Volume is surging, already crossing 100 million shares, which indicates that this is not just passive accumulation. This is likely a mix of short covering and high-frequency trading algorithms reacting to the technical breakout above $1.90. For those of you managing your own portfolios, perhaps using Robinhood stock trading or SoFi Invest, this kind of movement can be incredibly tempting to chase. You see the green candle, you see the double-digit percentage gain, and the instinct is to hit the buy button. However, professional traders using platforms like Interactive Brokers or Fidelity Investments are looking at something different: the short interest. We will get to that in a moment, but understand that today's price action is a violent reaction to the company's recent completion of a $375 million convertible note offering. Let's pause and really look at that financing deal, because it is the engine driving this volatility. The expectation was that Plug Power would run out of cash or be forced into a toxic financing deal that would wipe out shareholders. The reality is that they managed to secure $375 million at a 6.75% interest rate, primarily to pay off high-interest debt that was costing them 15%. Think about that for a second. They essentially swapped credit card debt for a mortgage. It's not free capital, and it comes with dilution risk because these notes can convert into stock at around $3 per share. But it buys them time, and in the stock market, time is the most valuable asset a distressed company can have. This move has confused the bears. The short sellers were betting on a liquidity crisis now, not a refinancing that extends the runway into 2026. This misalignment between what the shorts expected, immediate crisis, and what happened, refinancing, is creating a squeeze potential that makes stocks like this move faster than Nvidia stock on a quiet day. Now, I want you to consider the broader context of where this company sits. Most people think of Plug Power and think forklifts or failed green promises. That is the legacy view. The deeper analysis shows that Plug is sitting on valuable electrical infrastructure, substations, and power capacity that is suddenly worth a fortune because of the AI boom. We have seen reports that Plug is looking to sell or lease its power infrastructure in places like New York to data center developers. This is the aha moment. While everyone is arguing about the cost of hydrogen per kilogram, Plug management is realizing that the grid connection they built might be worth more than the factory itself right now. If you are an individual brokerage client trying to find an edge, this is the kind of second-level thinking you need. It's not about the gas, it's about the gigawatts. But let's get back to the charts here, because the volatility here is critical to understand. If you're trading this on Web Bull Trading or the Robinhood app, you might be seeing the price whip back and forth by pennies every few seconds. This is characteristic of a stock with high beta and high retail interest. It feels very similar to the early days of SoFi investing discussions, where the community sentiment could move the price as much as the fundamentals. Today, $1.93 is the battle line. If the stock can close above $2, it triggers a psychological shift. The $2 level is a massive resistance point. It's a round number where many limit sell orders are sitting, likely placed by frustrated investors who just want to get out at break even. However, if the institutional volume we are seeing today pushes through that wall, the lack of resistance above $2 could see the stock run toward that $2.25 analyst target very quickly. Speaking of analysts, the consensus is still largely hold, which in Wall Street terms is often a polite way of saying stay away. But why are they saying that? They're looking at the cash burn. Plug Power has been burning through hundreds of millions of dollars a quarter. The expectation is that this burn continues forever. The reality, however, is that the company has suspended some of its most capital-intensive projects. They are stopping the bleeding. By pausing the build-out of certain hydrogen plants, they are preserving cash. This is a mature decision, albeit a painful one. It signals that management is finally listening to the market. They are prioritizing survival over growth at all costs. For a long time, Plug was priced like a growth stock, similar to how people used to view Tesla stock in 2015. All promise, massive losses. Now, it's being priced like a distressed value play. The risk is high, absolutely, but the risk-reward ratio shifts when the company starts cutting costs aggressively. I want to take a moment to address the short interest directly because it is the elephant in the room. Plug Power has a short interest of roughly 33% of its float. For those new to online investing, this means that 1 out of every 3 shares available for trading has been sold short by someone betting the price will go down. This is an incredibly crowded trade. When a trade gets this crowded, it becomes dangerous for the bears. If the price starts to rise, perhaps driven by this refinancing news or a new data center partnership, those short sellers have to buy the stock back to close their positions. Their buying drives the price up further, forcing more shorts to cover. This is the classic short squeeze mechanics. We've seen it with GameStop, we've seen it with AMC, and we see many versions of it in Nvidia stock when it surprises to the upside. With 33% short interest, PLUG is a powder keg. If you are holding shares in your Fidelity brokerage account or your Schwab Intelligent portfolios, you are essentially holding a ticket to a potential volatility explosion. Let's look at the institutional side. Who owns this stock? It's not just retail traders on Robinhood crypto accounts gambling on a bounce. You have major players like Vanguard and BlackRock holding significant chunks. Why? Because they have to, in part due to index funds, but also because there is a recognition that hydrogen must be part of the future energy mix, even if the timeline is delayed. Fidelity mutual funds that focus on green energy or alternative power often have exposure here. These institutions are not day trading. They are looking at the 2030 horizon. They know that heavy industry, steel, shipping, trucking cannot run on batteries alone. They need a fuel, and hydrogen is the only zero-emission fuel that fits the bill. The expectation is that batteries win everything. The reality is that batteries are too heavy for ships and planes. Hydrogen is the solution for the hard-to-abate sectors. Plug Power, despite its flaws, is the 800-pound gorilla in this space. They have the ecosystem, the electrolyzers to make the hydrogen, the liquefaction plants to transport it, and the fuel cells to use it. Comment below how many shares of Plug Power you currently hold, or if you are waiting for it to drop back to $1.50 before starting a position. I want to know if you are playing the short squeeze or investing for the 2030 energy transition. Now let's discuss the business model in more detail now that we have covered the recent madness. Plug Power essentially wants to be the oil major of the future. They don't just want to sell you the engine, the fuel cell, they want to sell you the fuel, the hydrogen, for the next 10 years. It is a brilliant model if you can produce the hydrogen cheaply. That has been the failure point. The cost of natural gas and electricity spiked, making hydrogen production expensive. But as renewable energy costs come down and interest rates eventually stabilize, that math could improve. They have huge customers: Amazon, Walmart, Home Depot. These aren't small pilot projects. These are massive distribution